Hello, everybody, and welcome back to the Open Interest YouTube channel. I'm Mike Coe. If you like to see regular updates on the most notable activity going on in the options markets, go ahead, like, subscribe, and hit that notification bell to be alerted when we release new videos. Big day in the markets today with the S&P rallying 1.6% and the NASDAQ up over 2.2%. At the moment, it appears to be giving back almost half of those gains, though, after hours, because Netflix earnings bombed for the second straight quarter. That stock is down about 26% after hours as I speak to you now, actually below $260 a share. That after they reported a 200,000 subscriber loss. That's the first in 10 years, and mentioning that they anticipate even further subscriber losses. That news hitting several other streaming services names after hours as well, although the company still hasn't delivered positive free cash flow. Netflix is now trading just 24 times trailing 12-month earnings of $10.73 per share. That's only one turn greater than the S&P 500. Maybe we could even begin to start thinking of it as a value stock. Options activity in Netflix wasn't overly bearish today going into earnings. Sentiment was fairly mixed, but I will offer a shout out to Investors Business Daily. They published a bearish put spread idea on Netflix ahead of earnings, the 350, 340. It might have been hard to imagine a move as big as the one we saw. That's probably why they were looking at a put spread. The options market had been implying a move of perhaps $40 higher or lower. At this point, it's down more than twice that amount. Looking at some of the more notable trades we saw today, XLF, the financials ETF, traded 2 times average daily call volume, and calls outpaced puts by almost 5-1. This was mostly due to a huge trade in the May 38.5 calls. Ultimately, over 81,000 traded at an average price of just under 50 cents. About a third of the financial select sector index has already reported earnings, including most of the biggest banks. The best performing names in the index were Signature Bank, Citizens Financial, SVB Financial, Fifth Third, and Franklin Resources. Insurance companies in the index were the worst performers on the day. Several of those actually closed lower. That included Travelers, Hartford, Chubb, AIG, and Aflac. The biggest bond ETFs, TLT, HYG, LQD, continue to see heavy options volume, all traded lower as rates were higher again today. In HYG, the top 5 most active contracts were all puts, although it appears this included a lot of profit taking. It's possible the bond bears are actually taking a breather from the high yield space. The top 5 most active contracts in TLT were also puts. Here, some of that activity was still opening, and other big bets were adjusting positions. For example, a trader rolled 10,000 weekly 121 puts, now in the money, down to the 117s, taking about 1.6 million in premium off the table in the process. We also saw a purchase of 6,600 May 116, 112 put spreads. LQD also hit fresh 52-week lows. However, here too, the bearish sentiment appears to be moderating, if only just slightly. One of the larger trades appeared to be betting LQD could actually bounce. A June 109, 119 risk reversal traded 10,000 times, selling the 109 puts at 87 cents to buy the 119 calls, paying 31 cents. That trade collects 56 cents. That's betting that the downside in LQD is limited to perhaps 4% or so, or at least this trader is willing to get long at that level over the next 2 months. SLV, the iShares Silver Trust ETF, fell nearly 2.7%. To me, the most notable trade were the October 22 puts. 5,000 of those traded for $1.29, seemingly targeting a move to or possibly through the lows of late 2021. BHC, Bausch Health, saw a huge opening trade in the July 28 calls. Over 37,000 of those trade at an average of 44 cents. Now, this is the second time recently we've highlighted some really large prints in this name. They have a conference, an ophthalmology conference, at the end of this week. They're going to be reporting earnings on, I think, May 2nd. So could be this trader is targeting one of those 2 events as a potential catalyst to propel the stock higher. However, they do have all the way until July for that to pay off. In any case, that would be an increase of better than 20%. ChargePoint saw big activity, 3 times the average daily call volume, up over 7% today. A buyer of 20,000 weekly 16.5, 17.5 call spreads risked about 340,000 on a trade that could be worth $2 million if it can rally another $1.13 or so by week's end. AT&T reports Thursday, currently implying a move of only 50 cents higher or lower. That's only 2.5% of the current stock price. Those options seem very cheap to me. That's less than the average move and certainly far less than the 8.4% the stock moved after they reported in January. Much of the flow were something called reverse conversions. For those who are unfamiliar, these are trades that are generally about the carry cost. So now we're talking about interest rates and dividends. So for example, a trader sold 14,000 of the May 20 calls at 34 cents, bought 14,000 of the May 20 puts at 81 cents, and bought 1.4 million shares, paying $19.52. So an options trader would refer to that entire structure by saying that the trader had converted and collected a penny to do that. The side that sells the shares is said to reverse. The side that buys the shares is said to convert. AT&T went ex-dividend on April 13th, and next goes ex-div on July 7th. So that's not in play really on this trade. Mosaic, ticker MOS, traded well above average put volume, 13,130 of the April 29th weekly 70 strike puts traded at 61 cents. Those expire prior to earnings, which the company is going to be reporting on May 2nd. Mosaic is up 98.5% year to date and over 140% over the past year. Now, Benzinga reported that these were purchased, and given the huge run, one can imagine a trader betting a small amount of the current stock price that it could turn. And in fact, the stock was flat to even slightly lower today. One of the few stocks that were. Nearly 90% of the S&P closed higher. But if so, the price of the trade looked more like an initiating sale to me at 61 cents. So, I think those options were about 60 cents at 67 when the trade took place, and that was near the stock's lows on the day. Also, the implied volatility, that's another way that options traders think about the price of an option, that also appeared lower. So I was looking at the 13Fs. Millennium held 21,000 puts in Mosaic, according to their most recent 13F, which admittedly only runs until the end of December. But if they do have a position, this could potentially be a trade to offset premium in long put positions prior to earnings. So essentially, if you had longer dated puts, you could still capture that catalyst and then sell some premium just to offset decay. These options expire before that catalyst. That's all I have for you on this segment. Again, please be sure to like, subscribe, ring that bell. If you leave us a comment, we'll try to answer it. Thanks for watching. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_Co, or go to our website, www.openinterest.pro. Thanks for watching.